probably the only way you could do better than going with an RBC InvestEase portfolio is simply...
Welcome to another episode of Robo Review. In this video, we analyze the portfolios from RBC InvestEase.
Thank you, Irene, and hello, everyone. If you are new to the channel, I am Justin from Tater, and here we help Canadians with investing, help you understand what you are investing in, help you minimize fees, help you find a better alternative if you don't like what you're investing in, or maybe it's not right for you. Today, we are opening up the portfolios from RBC. They call them their InvestEase portfolios. We're going to unveil all of the individual holdings in these portfolios. We'll look at the cost, the fees, the structure, how they all work so that you understand and can determine if these portfolios are right for you. We will also show you our Tater Portfolio Manager, which is a proprietary spreadsheet that can help you easily build and manage these portfolios on your own and save on all of the fees. And those fees can add up to a huge amount over the long term. We're talking easily into the six figures. So stick around for that. And with no further ado, let's get into it. First, we will look at RBC's growth portfolio, which is one of their more popular ones and contains all of the same ETFs as their more conservative and more aggressive portfolios, with the caveat that there is one missing. It is basically the short-term equivalent of their aggregate bond ETF, XBB, which we will talk about momentarily, but the short-term equivalent is XSB, and it is found in their more conservative portfolios. As you can see, the growth portfolio contains 70% equities, 30% fixed income. The MER is a very competitive 0.14%, among the lowest in terms of robo-advisor portfolios in Canada. Now, there's an additional and more significant cost when you invest with RBC InvestEase. That is 0.5% of your entire portfolio each year, and that is on top of the MER. So for the growth portfolio, you would expect to pay 0.64% each year. And as we mentioned earlier, towards the end of this video, we are going to show you how to easily build and manage these portfolios on your own and save on all of the fees, which can amount to a huge amount of money over the long term, so stick around for that. For now, we are going to run through each ETF in the portfolio and provide a synopsis of each. We will start with the bond ETFs as they are first on the list, and I know they're not the most exciting, but we will get through them pretty quickly and on to the more exciting equity ETFs very soon. First up is XBB. This is iShares Core Canadian Universe Bond Index ETF, a very popular bond ETF in a lot of Canadian robo-advisor portfolios. So it is a low-cost way, as you can see here, to obtain broad exposure to the Canadian investment-grade bond market. Now, investment-grade bonds are very high-quality bonds, extremely low chance of default, so it makes sense that all of the top 10 holdings are Canadian government bonds. The MER of this ETF is 0.1%. As we hop over to page 2 of the fact sheet, you can see the sector exposure, 40% federal government, over 33% provincial, and those are typically the highest quality bonds. When you get into corporate, for example, financial, energy, and infrastructure, they get to be a little bit more risky, so you get down into the credit ratings of A or maybe triple B, but still the corporate bonds held in this ETF would be of a very high quality. So this would be a very dependable bond ETF, which is really what you want from your fixed income in your portfolio, is that stability. And just wanted to make note of the maturity breakdown. So this is the duration of the different bonds in this portfolio. Shorter term bonds typically are less volatile, but they also provide lower returns. Conversely, long-term bonds offer higher returns, but have more volatility. So having a good mix of short, medium, and long-term bonds is a really good way to get a solid return, but also not have too much volatility. Okay, let's hop back over to the portfolio. The next ETF on the list is XIG. This is iShares US Corporate Bond Index ETF. In an attempt to increase returns for the fixed income portion of this portfolio, they have added this ETF to the list, and it contains strictly US corporate bonds. All of them are considered investment grade. And we'll get into on the second page, they are a little bit lower quality than government bonds. So the trade-off is a little bit higher of a return for a little bit more risk. But they have nullified some of the risk, the currency risk, by hedging this back to the Canadian dollar. So just a little bit on currency hedging itself. It protects against the risk of foreign exchange rate changes. So in the case of this ETF, if it was not hedged to the Canadian dollar, when the Canadian dollar went up, the value of your investment would go down. Conversely, if the value of the Canadian dollar to the US dollar went down, the value of your investment would go up. Because this ETF is hedged to the Canadian dollar, you would not see the benefits of currency fluctuations, but you also would not see the downside either. Hopping back over to the fact sheet here, you can see that this ETF is a great way to access over 1,000 high-quality corporate bonds in one single fund. The MER, the management expense ratio, significantly higher than what we've seen before, and that is partially due to the currency hedging of this ETF. Hedged investments are typically more expensive than their unhedged counterparts. Scrolling down, you will see that the maturity breakdown is a little bit different than XBB. They have more weighting towards medium and long-term bonds. So investors will see a little bit more volatility than if they had more short-term bonds in here. The credit ratings, as we mentioned before as well, because these are investment-grade corporate bonds, they are either A or BBB rated for the most part. The next ETF on the list is XGGB. This is iShares Global Government Bond Index ETF. It is also hedged to the Canadian dollar, so foreign currency fluctuations would not affect the value of your investment. As we have a look at the fact sheet here, you can see that the MER has come in at a more reasonable 0.22%, albeit twice as high as the first bond ETF on the list, XBB. Here you can see that the top 10 holdings are all U.S. Treasury notes, but those top 10 investments only take up 3.8% of the portfolio because the total number of investments is 1,356. So again, a huge number of individual bonds held in one single ETF. And as we have a look at the geographic breakdown here, you can see the other countries other than the United States that are represented in this ETF. And they don't show the ratings here, but because these are government bonds, they would be extremely high quality. So in line with the government bonds from the first ETF we looked at, XBB, and a little bit higher quality than the corporate bonds in XIG. So that is it for the bond ETFs in this portfolio. Congratulations, you have made it through the fixed income portion of this portfolio review. And now on to the equities. Thank you, everyone. Thank you. If we could just calm down, Okay, let's get started. All of these ETFs are traditional index funds, which seek to track a broad-based index consisting of equities, otherwise known as stocks, and these indexes are cap-weighted, which means each stock in the index is weighted relative to its total market capitalization. So larger companies with a bigger market cap, take up a larger portion of the index. So because the ETFs in this portfolio all track cap-weighted indexes, the same thing that we said about those indexes can be said about these ETFs. The larger the company, the higher the weighting. Okay, let's get back to the portfolio and go through these ETFs. First on the list, XIC, iShares Core S&P TSX Capped Composite Index ETF. This is a popular one. I own it myself. The number one key benefit, as you can see on the fact sheet here, you own the entire Canadian stock market. Now let's talk a little bit about the index that this ETF seeks to track. So the S&P/TSX Capped Composite Index does all of the things that we described when we were talking about cap-weighted indexes, but it says that it is capped, which actually means that the largest holdings will be capped at 10%. So an example is Nortel back in the day in Canada owned a much larger chunk than 10% of the market share. And that isn't currently the case. You can see the Royal Bank of Canada takes up just over 6.5% of the index. If that ever gets to over 10%, then it will simply be capped at 10%. So no one stock will ever take up too much of this ETF. And as we go through the rest of the top 10 holdings, this is a pretty good list of the largest companies in Canada. The MER is a very solid 0.06%. So this is also a very inexpensive way to own the entire Canadian stock market. Back to the portfolio, and the next ETF on the list is XUS. This is iShares Core S&P 500 Index ETF. It is basically the US version of the Canadian ETF XIC. The caveat is that it is not capped. So if any one holding takes up more than 10% of this index, then that will also be represented in the ETF. So you can see a pretty extreme example here, or what looks like a really extreme example. However, looks are deceiving in this case, as the only holding, apart from a little bit of US and Canadian cash used for currency conversion, the only holding is iShares Core S&P 500 ETF in US dollars. So that ETF is IVV. If we have a look at that fact sheet, it tracks the S&P 500 index, which contains the 500 largest companies in the US. So owning this ETF, or the Canadian dollar version XUS, is a great way to own the top 500 largest stocks in the US. As we have a look at the top holdings here, you can see a lot of recognizable names, the largest companies as measured by market cap in the US. Hopping back over to the XUS fact sheet here, you can see the MER is a very respectable 0.09%. And if you look at the MER of IVV, the US equivalent, you will notice it is much lower, 0.03%. And this is typical. US dollar versions of ETFs almost always have a lower MER than their Canadian dollar equivalent. And this is due to the cost to convert the currencies into Canadian dollars. You can also call it a cost of convenience, just because for Canadians, of course, dealing in Canadian dollars is more convenient. Back to the portfolio, and the next holding on the list is the International Equity ETF, XEF, and get ready for a lot more acronyms here. This is iShares Core MSCI EAFE Index ETF. Now, to explain what all of that means, we can simply look at the fact sheet, since this ETF seeks to track this index. So as per the key benefits here, XEF provides, of course, international portfolio diversification, since it's an international ETF, and it's a low cost and simple way to own over 1,500 stocks from Europe, Asia, and Australia. But as you can see towards the right side of the fact sheet here, the number of holdings is much higher. As of the end of July 2024, it was over 2,500. And the MER, 0.22%, considerably higher than what we've seen for the other equity index ETFs, but you have to consider the number of countries and stocks involved in this ETF. Pulling all those together and converting to Canadian dollars for our convenience certainly has a cost. So 0.22% to accomplish all of that is actually very reasonable. And if we scroll down a little bit, we can see the top 10 holdings in this ETF. Now, neither this ETF nor the US dollar equity index ETF were hedged to the Canadian dollar. And there are reasons why you actually don't want to hedge in this case. As you saw earlier, the international bond ETFs were hedged, but when it comes to equity index ETFs, we don't want to hedge. One reason is for currency diversification. By not hedging, you gain exposure to foreign currencies, which can help diversify your overall portfolio. In times of economic turmoil, many people across the world flock to currencies such as the US or some European currencies like the Swiss franc. So having exposure to these can actually provide some extra portfolio stability. Another reason you don't want to hedge in this case is for cost savings. Currency hedging can be a little bit expensive, and these fees are passed on to us investors. So by avoiding hedging, we reduce some of our costs. The final reason we don't want to hedge, long-term performance. In the long term, currency fluctuations tend to average out. While short-term volatility might affect our returns in the short term, over longer periods, the impact of this currency movement is typically minimized. Getting back to the portfolio, and the last ETF on the list proves that we are not done with acronyms. The iShares Core MSCI EMIMI Index ETF. This is XEC, and as we look at the fact sheet here, you can see that it seeks to replicate the performance of the MSCI EMIMI Index. So you can see that those letters stand for Emerging Markets Investable Market Index. So this is the index that this ETF is looking to replicate, and by doing so, it offers the long-term growth potential of emerging markets and a low-cost way to own over 1,500 stocks from these markets. Now that is what the fact sheet states, but as you can see, the number of holdings is actually over 3,300. So a significant number of holdings, and this contributes to the 0.27% MER, also a contributing factor over and above the developed market equity index ETF is just that more constituents go in and out of this index because it is more volatile, being that it covers emerging markets. Finally, as we scroll down on the fact sheet here, you can see the top 10 holdings in this ETF. So that is the last ETF we are going to cover, but make sure you stick around because we have saved the best for last. We are going to show you how to easily build and manage these portfolios on your own to save a life-changing amount of money over the long term. Definitely worth it to stick around for that. And then we'll cover the other options provided by RBC. They do have 4 other portfolios, and the only more aggressive one, which we are looking at here, is aptly named the Aggressive Growth portfolio, where, as you can see here, they just ditch all of the fixed income apart from, of course, the cash. And so this is, as you can see, a very aggressive portfolio with all but 2% invested in stocks. In terms of more conservative portfolios, RBC offers 3 options. Their balanced portfolio, a little bit less aggressive than the growth portfolio at 55% equities, the conservative portfolio at 35%, and then the very conservative portfolio at 20% equities. So these portfolios are really great, among the best robo-advisor portfolios in Canada. Probably the only way you could do better than going with an RBC InvestEase portfolio is simply purchasing these ETFs on your own. And using our Tater portfolio manager, we make it super easy to build and maintain these identical portfolios on your own and save on all of the fees, which can amount to like a 6-figure difference in your portfolio over the long term. And it's not very time consuming at all. It's definitely worth your time to build this portfolio on your own. When you look at the dollars per hour that you save or that you really make by building these portfolios on your own, it really amounts to thousands of dollars per hour, because in a lot of cases, it only takes a couple of hours per year to manage these portfolios on your own, to invest a little bit more money. We make that super easy. We also make it really easy to rebalance the portfolio, and you only really need to do that once a year. So building this on your own, really easy and really worth it. So let's show you how to do it. Really quick, just wanted to show the amount investors can save over the long term just by investing in these ETFs themselves. It's really remarkable. As you can see across the top, this is the initial investment amount, and then along the side, the investment horizon is the number of years invested. So over 20 and 30 years, you can see the different amounts investors could expect to save simply by eliminating the fees from RBC. So as you can see here, even if you only have $50,000 to start, after 30 years, you could expect a portfolio improvement of over $126,000 just by eliminating these fees. Let's now hop over to our Tater Portfolio Manager, and we will show you how to use it to build one of these portfolios on your own. Since we looked at the growth portfolio, that is the one we will open up from our menu here. But as you can see, we've loaded in all of these portfolios from Wealthsimple, Modern Advisor, Questrade, CI Direct, and RBC. So you can build any of these portfolios on your own using our spreadsheet here. We'll click on the tab here to open up the RBC growth portfolio, and all you have to do is enter the initial amount you have to invest. So let's say 50,000. And then you simply purchase the number of shares shown in the shares to buy column. And when you do that, you fill in the table below once you actually own the shares. So 234, 243, 136, 369, 170, 210, and 150. And then you can see the remaining uninvested cash is just over the 2% called out for in this portfolio. In the future, when you have additional cash to invest, you would enter it into this cell. For this example, let's say we have $5,000. We'll just enter that. And then the far right column will show you the number of shares you need to buy in this situation. And then this column also shows you the number of shares to buy or sell to bring your portfolio back into balance in the future when share prices fluctuate. And as mentioned before, investors really only need to rebalance one time per year, so very little time is involved in managing these portfolios, and this time is very valuable. It can be worth thousands of dollars per hour just based on the long-term savings. Our Tater Portfolio Manager spreadsheet is free for a limited time for our YouTube subscribers, so let us know if you are interested. We also provide instructional videos and help along the way via email. Before you do anything else, make sure you have subscribed and rung the bell, wherever it is, to make sure you don't miss out on our next video. If you like this one, then you can click like too. We would appreciate that. And if you would like that spreadsheet that we showed in this video, our Tater Portfolio Manager, to help you build this or one of the other portfolios on your own, just let us know. Leave us a comment, and we will see you next time.